The best of money matters. Wealth Tracker.
Welcome to the Wealth Tracker, where we dive into the uncharted territories of niche investment strategies that promise to redefine wealth. Hello, I'm Hongbin, Jeong. As climate risks become increasingly financial in nature, institutional investors are under mounting pressure to align portfolios with a net zero future. Across APAC, more firms are beginning to map out climate transition plans, yet progress remains uneven, particularly in ASEAN markets. For investors, the challenge isn't just navigating the flood of new disclosures. As figuring out how to turn that data into real financially material insight and ultimately into capital allocation decisions that can both protect portfolios and drive decarbonization. So where do the biggest opportunities lie today for institutional investors to take meaningful climate action? What barriers still stand in the way? And how can investors balance fiduciary duty with long-term sustainability goals? Well, to find out more, joining me now right here in the studio is Anthony Chan, who is the Vice President of APAC Sustainability and Climate Research at MSCI. Anthony, welcome to the show.
Thank you for having me.
Thank you so much for joining us. Well, Anthony, I just want to start off by asking you, how would you assess the current state of climate transition planning across APAC?
Well, I would say that the climate transition landscape in APAC is strong. And I think I'll just break it down by helping the listeners understand what this is about. Climate risks are becoming increasingly material, and companies are expected now to go through a transition planning process to understand what these risks are. Some risks are, for example, carbon taxes, and some of them could face physical risks that arise from climate change. And based on our recent MSCI APAC Climate Action Report, we found that in the APAC region, there has been good progress with the number of companies that have issued a transition plan, increasing from 12% in 2022 to now 22% in 2024.
Okay.
While this started from a relatively low base, I think it also reflects that the regulators are now understanding that this important risk and getting companies to disclose them, provide more information on them through their annual reporting.
Well, how about Singapore specifically? How is Singapore emerging as a key player in developing regional carbon markets and making an impact of carbon solutions in climate transition?
Well, Singapore is definitely positioning itself as a climate champion, and you can see these progress in many different parts of the climate finance ecosystem. Starting from reporting, for example, you do see that many large listed companies have provided their climate disclosures ahead of the mandatory disclosure timeline, which is from financial year 2025 onwards. But that's just one aspect of progress and developments here. You do see also developments in the voluntary carbon market space. Just last week, the various agencies have put out a set of guidance on how companies can use carbon credits credibly to support their decarbonization plans. And these are just some facets of key developments in Singapore.
Okay, well, as we shift toward a mandatory disclosure regime, the challenge is likely not lack of information, but translating that into meaningful and decision-relevant insights, right? So what tools or frameworks are most useful in turning that flood of data into investment-grade insight?
Well, great question. And indeed, not all information or data that is disclosed is analyzed. And while technologies such as AI can help to close the gap, we still need some frameworks to guide how these technologies can be used. So I'll break it down into three key points. The first key point is materiality. In sustainability assessment, materiality, which is identifying financially relevant issues, is at the heart of our assessments. And the second part, I think, is about data quality. I think we need to understand sustainability data is quite different from financial data. It requires an understanding of operating metrics of a company. It also requires an understanding of environmental metrics, these two put together.
Right.
And the last thing is about finding accurate leading signals of change that are in a company's financial and non-financial performance. At MSCI, we do this rigorously, and we do this in our ESG ratings as well as our new energy transition framework.
So how do you determine which emissions or transition risks are financially material across different sectors or regions?
Another great question. So here's the thing. While every ton of emissions create the same climate impact, the ton of emissions doesn't exert the same financial pressure on companies. And we are in this situation because we don't have a global carbon market yet, and carbon pricing policies, just based on a recent World Bank report, only covers about 28% of global greenhouse gas emissions. So it is important for us to understand that to break down these financial risks into tons of emissions that matter for companies. To give you some example, if a company is a power generator, the direct emissions of that company would matter for them financially, and they should be expected to cut these emissions quickly. And on the other hand, if you have a fossil fuel producer or a car maker, it is the downstream emissions that matter for them financially, emissions from the use of the fuels and emissions from the use of the vehicles. So in the way we assess financial risk, we think that carving out financially material types of emissions brings a clearer and more accurate risk signal for investors. And then that motivates the right discussions on how companies should reduce their emissions.
Interesting. Well, in an investment perspective here then, Anthony, how can investors differentiate between a company that's truly transitioning versus one that's simply good at reporting? Yes.
So I want to go back to the point I made about finding signals and key leading signals. So, and there are two things we need to look out for. First, identify credible markers of transition. And what do we mean by that? Companies can report various kinds of progress, but what really matters based on our research are two things. First, the governance structures of companies and the strategy that they have in place. And we found that companies that have disclosed robust governance measures, robust strategies, tend to reduce their emissions down the road. Another key point to look out for is the capital expenditure plans of these companies. And likewise, based on our research, we see that if a company has laid out clear capital expenditure plans, we do see decarbonization progress down the road. But increasingly, it is not just putting out these governance and strategy disclosures. It is also about demonstrating an understanding of the various challenges that the companies might face in the transition. So we look out for two things. One, which you can broadly call transition dependencies, right?
Okay.
One is the policy environment that the company operates in. Is it conducive enough for them to undertake or investments in energy transition? And the other perspective is technology. Are there technology barriers that can limit the adoption of the technologies or prevent decarbonization?
Okay. Can climate-aligned investing still deliver strong risk-adjusted returns, or is there a trade-off to be made?
Well, I think to begin, if we look at the long-term returns of climate-aligned investing, and this is based on the data on the long-term returns of the MSCI All-Country World Index, Climate Paris Aligned Index, we do see that the returns have been comparable to its parent benchmark. So, but having said that, there are also some things to take note of. There are certain segments that did not perform so well, and these tend to be frontier technologies, hydrogen, and other advanced biofuels, for example. And I think it's also important to note that the prevailing forms of climate-aligned investing have largely focused around companies' emissions ambitions, emissions targets, and their emissions track record. While that remains a very important area to look at, it is also important to broaden our view to look at other, a more holistic assessment of companies' transition in our assessment of risk. One example, going back to policy, is that if you put companies in the right policy context, we may find that there are certain companies in certain sectors that face fewer transition risks because there are not many technology options available for them. And on the other hand, if we bring in the angle of technology, then that broadens our view to understand the commercial adaptability of the technology. And just to bring out one research finding from the MSCI Sustainability Institute, it was found that there are a number of clean tech champions in the Asia-Pacific region they are seeing more than double-digit high growth rates in their annual year-on-year revenue. So with this broadening of our approach to cover policy and technology, it may bring forth new investment insights.
Okay. Well, you mentioned transition risks there, but what are some indicators that investors should pay closer attention to when assessing these transition risks?
Yes. The materiality-weighted emissions, understanding the scopes of emissions that matter, that's point number one. Point number two, policy. Understanding whether the company is operating in a jurisdiction with high carbon pricing and jurisdiction with strong emissions reduction measures. That's number two. And number three, technology options. That, again, in a sector with few decarbonization options, maybe the near-term transition risk is lower as opposed to one where the incumbent technology is already facing high pressures.
Well, then what role do you see voluntary carbon markets playing in the broader net zero transition, especially here in Southeast Asia?
Well, voluntary carbon markets have gone through a challenging phase over the last few years. If you look at data from the MSCI carbon markets, the amount of carbon credits that were retired by corporates to fulfill their emissions targets have remained static at around 180 megatons per year. So to put things into context, that's about 4 times the annual emissions of Singapore, meaning not a lot of our global emissions. But when it comes to climate mitigation, I think it's important to note that we need an all-of-the-above approach. We need more tools in our toolkit. And voluntary carbon market serves that purpose by providing an option for emissions reduction in companies, for companies that are in hard-to-abate sectors, number one, and also an option for countries like Singapore where domestic carbon mitigation options are limited. So based on our projections, we do see a strong role for voluntary carbon markets in going forward. Southeast Asia is mainly positioned as a supplier of credit. Over the last 10 years or so, the amount of carbon credits issued within Southeast Asia stood at around 10% of global carbon credit issuance. There's a lot of scope for Southeast Asia to play an important role in this regard.
Okay, but how can investors and buyers assess the quality of carbon credits in a still fragmented and sometimes opaque market?
Yes, while the market has gone through a challenging period, I think there has been a raft of measures on both the supply and demand side to shore up confidence in the market. And it's mainly targeting and doing 3 things: stronger governance, greater transparency, and greater trust in the integrity of the credits. So there are few things to look out for. The first is that while carbon credit registries, for example, Vera and Gold Standard, these are the largest registries, can provide methodological rigor across different kinds of projects. We also need to understand that there are different kinds of project risk that can arise from carbon credit projects. In our view, there are two types of risks that we need to be mindful of. The first is whether the ton of emissions that is partly to be reduced or removed from the atmosphere under the carbon credit is actually a ton of emissions. So that's what we call emissions impact integrity. And the other question to answer is, do these projects eventually come into fruition? Are there delivery risks? Are there implementation risks? We call it implementation integrity. These are the 2 key dimensions that we can look out for, and carbon credit rating agencies providing these kind of services. MSCI, we do it through the MSCI carbon project ratings. And this can be a useful tool for investors and buyers to understand the underlying integrity of the credits.
Okay, then overall, what safeguards are needed to ensure that carbon markets are not only effective but also credible in the long run?
We talked about supply integrity at the project level, and that essentially is ensuring that the project represents a ton of carbon emissions removed or reduced. But on the other side, another key dimension in integrity is demand integrity, which is essentially providing some guardrails around what kind of environmental claims company can make from the use of carbon credits. And here, there have also been a raft of measures that have been introduced on the demand side. While consensus is still being reached, I think with clearer guidance that can help also improve the demand side of the market by giving clarity on how companies can make use of it. Can they use it on the road to net zero? Or can they use it only to compensate the emissions that it cannot reduce?
Well, do you see sufficient demand side growth to support Southeast Asia's supply ambitions in carbon credits?
So in the short to medium term, I think that demand growth will likely be shaped by the compliance market. So what do we mean by that? In the short to medium term, we do the international aviation, for example, could become an important source of demand because airlines for now have to comply with the first phase of the implementation of what the industry calls the CORSIA framework. On the other hand, we also see that more and more compliance carbon markets, essentially carbon pricing schemes introduced by authorities in various countries, are also now allowing a portion of companies' carbon pricing obligations to be met by carbon credits. So these two drivers will likely shape demand in the short to medium term. But for Southeast Asia, it is important to also look at the longer term because the next question then is if there is consensus on how carbon credits can be used in the compliance market and how carbon credits can be used for voluntary carbon targets. Then the next question is there enough supply of credits to fulfill that kind of demand? And here, the buyers are already exhibiting a push towards higher quality credits. More and more buyers are looking at high quality credits such as carbon removals that command a higher price in the market because of their higher integrity. And for Southeast Asia, this is about broadening the types of credits that we have available. For now, it is still dominated by nature-based credits, and it will likely still be an important part of the supply equation going forward. But more frontier or new types of credits, for example, transition credits to support the early retirement of coal-fired power plants in the region. 50% of the region's energy still comes from coal-fired power plants. So that can then be a new source of credit to support, to meet the demand for credits that is already pushing towards higher quality.
Some great insights from you there. Thank you so much, Anthony, for joining me today.
Thank you.
Thank you. That was Anthony Chan, who's a Vice President of APAC Sustainability and Climate Research at MSCI. This has been the Wealth Tracker with me, Hongbin Jeong.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance. To listen to more great interviews, download our podcasts at audio.sg or download the audio app. That's AWEDIO, audio at the App Store and Google Play.